The 2023 Wings to Fly Scholarships cohort has been selected. The 1,000 students were identified after a thorough process that ensured only the bright and most needy scholars who sat the Kenya Certificate of Primary Education exams in 2022 were admitted to the program. The Wings to Fly Scholarship Program is a partnership between Equity Group Foundation and Equity Bank, with additional financial support by the German government through KfW, MasterCard Foundation, USAID, UK Aid, private institutions and individuals.
At Independence, we said we had the three enemies: ignorance, poverty and disease. That's what this foundation is all about. Look at education. Equity has devoted itself to solve this problem to the best of its ability. But it's not solving this problem, but creating leaders who it can partner with in the future to solve these problems.
The initiative to support disadvantaged students pursue education is geared towards positively transforming their lives and their families, but more fundamentally, developing the next generation of transformative leaders.
The poverty index pia wenye wako chini kulingana na makaratasi yale ambayo muliandika tuliyapitia zote.
The scholarship selection process started with public announcements throughout the whole country through religious organizations, local and national radio stations, social media, and local administrators. The applicants, after shortlisting, were then invited for interviews at appointed locations where scholars and their guardians first met the Community Scholarship Selection Board, CSSB members.
Kazi tunafanya hapa ni kazi ya haki na kazi ya ukweli. Hakuna upendeleo. Bank manager hana anything to do with influencing.
These forms are very available. You go to the bank, you find them free of charge. You go to the equity agents, you find them there.
It is almost a 3-kilometer hike up Marini Hill where Michael Kemei and his grandmother, Cheptanit Paulo, are about to receive guests. Members of the West Pokot CSSB have paid them a visit after a successful interview to secure a slot in the 2023 Wings to Fly Scholarship.
I used to live with my father. When my second mother came, it started by not wondering me. So I came to live with my grandmother. I scored 352.
The family has only one hut that they call home.
My grandmother sleep here and me, I will go to look for a place to sleep. There was a time my friends refused to open the door for me to sleep there, and I was forced to sleep outside. I sleep in the bushes.
Cheptanit, or Goko, has not been down this hill in 5 years. A snake bite that has since healed almost took her life. A clerical error of her date of birth on her national identity card renders her too young to access cash transfers for the aged.
The stories we get from these learners, they move us and we give them per merit. Some of those students who are left out, personally I've taken 2 of them and I'm assisting them in their schooling.
Mitchell Modhoni hails from Matongo village, Muranga. The 14-year-old lives with her single mother who ekes a living from mining sand. Mitchell has never known her father as her parents parted ways when she was still a toddler. Her mother later moved into Mitchell's great-grandmother's home.
Main challenge was school fees. Since my mom sometimes couldn't get a job, so I had to get out of school and come back home, wait until she gets some school fees, then I can.
Let us pray. Our dear Heavenly Father, we want to thank you this morning. We want to bless your holy name for your loving kindness and for giving us a wonderful day this morning. As we gather together today, we want to thank you for your unfailing care and support that we have experienced in the past. We thank you for the year 2022. We bless you because you are together with us. We thank you even for your word, which says that all things work together for good for those who love you and those who are called according to your purpose. As we gather together this morning, we pray for your presence. Be with us through and give us a wonderful meeting. For this we pray in Christ Jesus our Lord. Amen.
Let's appreciate Bishop. For those who will be tweeting, and kindly use the hashtag equity 2022 results, full year results, and we'll also be sharing it on the screen. But allow me to invite the Group CEO and MD, Dr. James Mwangi, to take us through the full year results for Equity Group 2022. Dr. Mwangi.
Thank you very much, Alex. Esteemed investors, shareholders, media, representatives for the state, analysts. It's really a great honor to host you this morning as we go through the 2022 full year results for the Equity Group. So without much ado, let me try and look the context in which these results are being released. The background is all outlook from a global macroeconomic perspective. We're experiencing through growth rate. We are seeing an emerging trend of declining growth rates, a forecast of sharp turbulence in the macroeconomic environment, both from an inflation point of view, from exchange rates, from valuations, from interest rates. And so that is the background upon which we are releasing these results. When you look also at outlook in terms of growth rates, looks depressed, and our hopes are only recovery will be from 2024. We have seen how, particularly in Kenya, from 2016, it has been a continuous challenging environment. We started with interest capping at almost the sovereign interest rate. Then we went into the COVID pandemic, and looks like the global economic disruptions of supply chains, and essentially the macroeconomic turbulence induced by that environment, high inflations, increase in interest rates to try and tame inflation, and as a consequence, very volatile exchange rates and devaluations of currencies of emerging economies. All these put together, because there are the economic prices and are the foundations of a financial system, has completely shaken the banking sector or the financial sector. And we see what has happened to valuations, market caps, quality of asset portfolio of the banking industry. So that is the background against which we are releasing these results. But when we then speak specifically about the results, because we have had a prolonged period of uncertainty, of shocks and challenges, we'll look at it from the strategic path that Equity chose to manage this. And so it is from a strategy perspective, and we look from and the group to navigate turbulence and shocks. So from the onset, we felt in challenging times, then you focus on non-funded income because that is the least affected source of income. We downplayed on balance sheet income or funded incomes. And broadly, we have seen that total income during the year grew by 28% to 144 billion, made up of 58 billion of non-funded income, which grew by 33%, and net interest income of 86%, which grew by 25%. And when you do a deep dive, a 73% contribution of that growth is commission income from trade finance, guarantees, and off-balance sheet items. So essentially, the bank is moving away from funded income as much as possible, and we see non-funded income contributing 40% of the entire income of the group. That mix shows the quality of the earnings or the incomes of the bank, and that is graphic presentation of the same. And then we see specifically the deep dive, and I would really like to recognize Kennedy, who heads the trade finance team for really very good showing. Thank you very much, Kennedy. The second aspect of non-funded income is also efficiency in treasury operations. And again, there we see the movement in treasury because of contribution, the management of the entire portfolio, the yields, the mark-to-market, and again, that has all been observed by the group. At 31st December, we had the worst mark-to-market position, and yet after factoring that into the accounts, our capital holding significantly stronger than they were in the recent past, positioning the bank to have strong buffers and a very strong payout. The second one of the strategic intent was geographical expansion and business diversification, looking at strengthening the organization. And we see the dominance of Kenya banking subsidiary has significantly been reduced with 44% of total assets and total revenue coming from the subsidiaries other than Kenya. But of course, Kenya being what it is in terms of profitability, contributing 30% of the entire profit because it's a mature business and a very efficient business. But when you look at the individual growth rates of the subsidiaries, you see this year would be anticipating that the subsidiaries will carry the weight of 50% of the entire balance sheet. And again, continuing to minimize and de-risk the group from concentration of any sovereign risks. And exciting about the regional subsidiaries is their continued growth. And we see that when you look at return on equity, while Equity Bank Kenya has consistently done well, subsidiaries like Rwanda has now surpassed Kenya in terms of efficiency, in terms of return on asset and return on equity. And that short period to maturity of the subsidiaries, almost, and that is why we are confident the subsidiaries this year will contribute more than 50%. And almost, when you look at the period it takes for the subsidiaries to reach maturity, it took Kenya almost 16 years to reach 14% return on, a 4% return on asset. But we are seeing Rwanda has made it on the 11th year. And we are hoping Uganda should be able to do it this year. And we are seeing very good showing both in DRC and Tanzania as the subsidiaries. And so there is a possibility by 2025 we'll be dealing with a complete mature group without saying they are young investments, and hopefully achieve a 4% return for the entire group. And people then can put in perspective what that would then mean. The second aspect was really looking at the balance sheet, positioning the balance sheet to make it not only efficient, but agile. And you look at these numbers, it pleases us that when we are talking of challenging economic times for the financial sector, 16% of the entire balance sheet of 1.447 trillion is in cash, equivalent to 232 billion. And that is how well positioned the group is. And that is cash and cash equivalent. We're not talking about government stocks, which is another 27%, giving us a liquidity in excess of 52%. So the balance sheet has been programmed to be very, very efficient, very agile, and can easily be restructured because it's very, very liquid. And at a time like this, of strong challenges in the banking industry, cash is king. And we can see the challenges that so far have played out in the last 2 weeks, have played where cash is limited or liquidity is limited. But over the last 7 years, the strategic path that the group has pursued has efficiently positioned the bank. And you can see the delicate balance between profitability and stability. And I'm glad that we are entering through this difficult phase of the financial sector from a very strong point of balance sheet structure, agility, optimization, efficiency, such that the group is both very liquid, but at the same time fairly profitable. So the mix of the government, of the balance sheet structure, both from the asset side and how it is also funded. And you can see again, if you look at long-term funding for the group, you'll be putting up long-term funding or borrowings of 157 billion and 182, over 300 billion, approximately 23% of the balance sheet from the funding side, again, is long-term funding. It's capital and long-term debt, and that really positions the bank uniquely and, as we said, in a very efficient manner. And the efficiency of the bank can well be seen when you look at the yields on net interest margin, the yields on interest earning assets, and how the bank has efficiently been able to manage that while at the same time managing the cost on the liability side. And that is the efficiency, the margin that will help the business in terms of maintaining stability during trying times. The business has also continued to go through transformation to make it much more efficient. So this has been done through digitization and significant innovation efforts. And I'm glad to say now 97% of the entire group transactions is happening on customers' own devices and on third-party infrastructure, paving way for significant reduction on fixed cost and variable costs, because it's now on a self-service platform. And that explains why the efficiency of the bank continues to improve. That explains why the cost-income ratio of the bank continues to improve, because the model is going through a transformation from the brick and mortar to online banking, self-service on own devices, meaning the group doesn't need to really invest or deploy people to serve. The customers are serving themselves. To the customers, this is a great achievement because it's giving them freedom. It's giving them control over their money and compressing both the distance and geography such that banking to them is a 24-hour capability, and banking is able to fulfill lifestyle. We have accelerated this. We know that we turned the COVID crisis into a major asset to the organization. I used it as a tailwind to push adoption of digitization on online banking, and we are glad that we are now reinforcing that by creating e-commerce rails. And one of our best performing products now is Pay with Equity, which we have chosen to offer for free to help the economy become as efficient as equity has become by digitizing retail trade. And we see the adoption of e-commerce transactions, with Pay with Equity transactions growing by 393% during one single year, and the volume transacted growing by 281% to 524 billion. And that is at the retail commerce level. That is at the mama shops and the rest. But also, increasingly, we are seeing the adoption of smartphones in the country, and the growth of internet-enabled transactions also growing at 212%, and the volume by 136. And these are the biggest drivers of the transformation of the business model, making it very, very efficient. And we can see what has happened at the transactional level. 18 billion transactions using the brick and mortar infrastructure, and 1.3 trillion transactions using the mobile and internet capabilities. So broadly, we can describe Equity Group as an online business. When you compare these two, 18 billion transactions and 1.3 trillion transactions, then broadly, and that's what we said, less than 3% of the transactions are now outside the capabilities of online channels of the group. And it's the same when you look at volume. It is not just the number of transactions. It is not saying internet banking, mobile banking is for small volume transactions. We have overcome the phobia as a customer base and have embraced digital channels for normal business transactions as opposed to the small level transactions. And we can see the Pay with Equity and merchant business, how it has taken off. Again, meaning that people are reducing even mobile transactions now to go to the digital payments. So again, essentially, cash is the use of cash, the importance of cash is significantly reducing as people do digital payments. And that to us is the greatest takeoff. The e-commerce payments have taken off faster than mobile ever did. And we are very optimistic that the pay with equity merchants will transform. The strength of the group came from recognizing that it's the decision of the customer, and we were not going to force the customers on the channels. So we adopted the channels that were at the disposal of the customers, and as you can see, we have given a whole range of channels for the customers. But when we look at it, it is the pay with equity, the internet banking, and mobile banking that has attracted the preference of the customers. And this is what we have always said, being market-led. Don't force customers into a product or to a channel. Give them the freedom and then be market-led. And that is why we have focused on the channels that speaks to the customers. And of course, enable them with the rails, invest to process payments and to process fintech capability, build fintech capabilities for the organization. The next two slides, Alex. So we see the payments, we see the fintech capabilities in the next slide, all growing fairly fast. The e-commerce, the agency, the card business, the mobile and internet. And when you look at the gross revenue from the channels, you can see the number of transactions, the growth in transactions, and the revenue growth. But it's because we have given customers the choice. And that for us is what the recognition of the customer. And so we can see the drivers of business. The next driver is focused on asset quality and distribution and mitigation of risk. And once again, the affirmation of how inclusive the bank is. Retail business continues to hold almost 30% of the business. The small and medium enterprise, another 30% of the business. And since we are a very private sector driven bank, we see large and enterprises and corporates contributing another 40%. So it's 60% retail bank and 40% corporate bank. And as we can see, the public sector is only 6% of the bank. So it's a purely private sector focused group in terms of offering. But you can see the diversity within which that offering is made, as wide as the sectors of the economy. We don't discriminate the sectors, we support all the sectors because our customers are distributed in all sectors. And of course, we can see the contribution of DRC in terms of currency. DRC has become our second largest subsidiary after Kenya. And given that the operational currency in DRC is dollars, we can then see the balance sheet effect of that on the group. I want to recognize the effort of our customers in maintaining their contractual obligation, paying their loans, and one of the things we continue to celebrate was the wisdom of the board and management to support the customers through the COVID environment, ensure sharing loans. And as you can see, our NPLs, or non-performing loan book, is at 7.7 against an industry average of 13.3, meaning we are at 50% of what the industry is. We forever, the mutual relationship between us and customers has worked very well. We showed empathy, and customers in return chose to honor their commitments. We structured them to fit their new circumstances and the new situation, and this is what has really contributed to the strength of the book. Emmanuel, maybe Emmanuel could start. Emmanuel leads the credit team, and we are very, very proud of the credit team because the strength of a bank is known by the quality of its loan book. And you can see the confidence with which the bank steps up to support its customers even during a crisis like this financial crisis, because its loan book is of a very high quality. But it's not just the high quality, it's the conservative approach in risk management in credit. If you look, 94% of all that NPLs of 7.7 is fully provided for. The provisions have been taken. And in addition to the full provision, the bank has, in its conservative style, gone to take credit guarantees. So when you add the provisions plus credit guarantees, the NPLs are covered to a level of 123%. So provisions are 23% higher than the loan book that requires consideration. And this has enabled us to step forward very well at a time of global financial crisis, that you are confident. Your loan book is very good. What is NPLs is fully provided for. You have very high liquidity. You have very high cash positions. That is the basis on which equity has stepped up. And lastly is to really evaluate the final steps of the COVID rescheduled loans. All the loans have resumed repayment, and out of the 171 billion shillings, only 10 billion turned out to be struggling, and I'm glad to say that 10 billion is fully provided for in the 94% coverage. So it's a bank is in a point of strength, and we're coming for entering this phase and confronting this shock from a point of strength. When you look at efficiency and cost optimization, we see the cost of the bank has peaked significantly at 39%, driven to a great extent by the provisions. The provisions quality loan book, they would increase provisions by 180% from 4.9 billion shillings to 13.7 billion shillings. I believe the highest provisions made in the banking industry in Kenya, yet by the bank with the best loan quality. That speaks about the conservative nature of the management. The future is always important for us. We know our responsibilities to customers, and always good to focus on growth of the bank in a very solid way. The second big rise in cost was staff cost, and we have really strengthened the bench. When you are performing well, you pay your staff well, but more importantly, you continue strengthening the depth and breadth of skills. You don't grow the way we are growing and expect the people who brought you this far who the people who create the future. You thank those who have made contribution, but you look for the skills and the competencies that will build the future. And maybe that explains why our staff cost has gone up by 30%. We are happy to pay for the competence of our staff, the productivity of our staff. If there is one asset I'm proud of, and really I claim to have been very privileged to be a team leader, is the quality of our staff. Their passion, their enthusiasm, their productivity, their competence stands out. But complemented by that is the quality of our management. And the quality of our management can best be seen by the decisions they have made and how they have differentiated themselves from any other management that I know of. And that differentiation speaks loudly when you look at how different the bank is. from the rest of the banking industry, simply because of the quality of decision. Maybe just for people to appreciate, I would ask those who have joined the equity group for the last 2 years, maybe to be upstanding. If you joined the equity within the last 2 years. As you can see, that is strengthening the bench. The bulk of our management is a new blood team to come and strengthen, and we have laid the foundation for them. They bring the skills and competences to take us to the next level. Thank you very much, colleagues, for the confidence to join the equity group and make your contribution like those before you have made to bring the bank where it is. The future looks more busy. So when you look at that efficiency, it's very well manifested in cost-income ratio. The cost-income ratio of the bank continues to decline. The cost-to-asset ratio continues to decline, and that is what has really strengthened the bank. But this bank is not about numbers. Equity Group is not about numbers. It's not about deposit and loans. It's a human story. The question is, what have we done with this performance in terms of supporting humanity? We are a community bank built to solve the challenges of society. And essentially, that caused us to have two engines. Those who know, we have the commercial engine, the banking group, the insurance group, the technology group, the investment group, but we equally have the equity group foundation that looks at the interest of the community, that propagates the shared prosperity. And the group is most known for scholarships to needy, gifted kids. I'm really happy to say we have now reached 57,000 of Wings to Fly scholars. We have given 57,000 scholarships in just a short period from 2008. We're talking about a period of 15 years. And if you look at that, of those scholarships, the last 4 years of COVID, we have given 40,000 scholarships, meaning in class today, between Form 1 and Form 4, we have 40,000 kids. We would take the bragging rights of being the parents with the highest number of children in the Republic of Kenya. 40,000 kids in school simultaneously. But the balance of the 40 and 57, we have those 117,820 supported to proceed with their university education. The very needy ones, we have paid their school fees through internships in the bank, a paid internship. We pay them the entry salary so that they could be able to clear their school fees. And out of that 17,820, 761 have managed to become global scholars. And as you can see, we feel very, very proud of the success of this program. This program has put, out of the 761 scholars that we have sent globally, 219 are in the top 15 universities in the world. Now you can imagine what we have done for the future of this country in terms of developing resource. And universities like UPenn, Harvard, Yale, Cornell, dominating the list of the universities with the highest number of kids. This is how we use the earnings. The success of equity is not in profits, it's not in size of balance sheet, it's what we do for community. And to us, the flagship is the education program for the needy, the orphans. Out of these 57,000, 87% are orphans. And so, Dr. Joan, maybe you could stand, you and your team in the foundation. Dr. Beth, where is Dr. Beth, who is providing leadership in education? We're very, very proud of what the foundation have been able to do. Beyond education, which we are very, very proud of, is then the issue of health. And health, again, we take really great comfort that in focusing on health, we realized 40% of loan defaults occurs when a health incident occurs in the family, and all the cash flow of the family is diverted to address the medical needs. And we decided then the best way was to solve that problem. And the support of our chairman, Professor Macharia. Professor Macharia is with us in the room. Chairman of the group is a professor in medicine, ENT surgeon, together with Dr. Joan Kolila, medical doctor. They have helped us to set up the Equity Afya franchise. This franchise is owned and managed by our scholars who we sent to university and did medicine. Out of the 17,000 scholars who have done medicine, who have gone to university, 1,800 have done medicine. And I'm glad to say 78 of those doctors have now established 78 equity clinics. And our ambition is to have 300 clinics by 2025, such that we'll have the largest health franchise. We look with a lot of pride that last year, nearly 3 million Kenyans walked into those clinics to seek medical support. That, to us, is the greatest endorsement, a sign of confidence in the franchise. And it's just a question of time before Equity Afya becomes bigger than the bank. And so the social investment in society has been that very big. And when you look, you do a bigger deep dive, you see it is not just treating. When COVID struck 3 years ago, Equity Group contributed 1.4 billion Kenya shillings, $14 million at the exchange rate then. And for the last 3 years, we have maintained our commitment to provide 116 public and faith-based hospitals with PPEs. And you can see the total number of items that we supplied over the last 3 years, and we continue to provide to date is 96 million items, the highest number being surgical masks to be worn by doctors and disposable protective examination gloves for the doctors. We take pride that for 3 years we held our face up to say we'll protect community, we'll protect the health workers so that they could be able to, in confidence, to protect our Kenyan population. So essentially health has become very, very big. Challenging education. We now want to see which brand will be bigger, Wings to Fly or Equity Afya. Equity Afya or Wings to Fly. You can place your bet. But truly, this is what success to equity looks like. When we measure our success, we don't measure success in profit. Yes, we have to make profit to make the bank sustainable, to reward the shareholders. But for us, success is what did we do to community? When we were given a chance, when our community demonstrated faith to us, what is there to show for the faith, for the confidence that the society supported with. It's not only those two programs. One other program that we are very, very proud of is supporting the farmers. And I'm glad to say we have supported small and medium farmers, almost 400,000, to now become part of the formal supply chains. We have supported nearly 3 million farmers to move from peasantry farming to agribusiness, and that helps the household. But younger people are moving away from farming to business, and I'm really glad to see that a program we call Young Africa Works. Young people in Africa get jobs. We have been able to support 406,000 micro and small enterprises owned by young people and young women, and funded them to the tune of 223 billion. Initially, we knew poor people pay their loans. We now have evidence young people pay their loan. We have evidence women pay their loan. And you can see the evidence in the quality of the loan book. So we, the last 3 years of COVID, we have seen these 400,000 young people create 1.266 million jobs for their age mates, simply solving society's problem. That is what success for equity looks like. Partnering with the UN agencies and national governments, we are supporting 4.5 million households with social protection programs. And that again shows the significance. From the lessons that we can use social programs to bank the beneficiaries of social programs, we have established branches even in refugee camps. So we have a branch in Kalobei, in Kakuma, in Guru, and they are operating like anybody else. We are able to give loans to refugees, and in the process, they set businesses and they integrate with host communities. And that then truly creates shared prosperity between the refugees and the host communities. And that explains why 2020, we won what people call the Business Nobel Award, the Business for Peace Award, simply because of initiatives that reaches out what has never been done before. But more importantly is also looking at those households and the way we ensured they were not left behind when it came to financial inclusion. We adopted an inclusive model. We're saying the world is changing to clean energy. How do we support households? And I'm glad to say the last year we supported 375,000 households to acquire clean energy devices so that they are not left behind. Their health is as important as anybody else's health. Instead of using firewood, then they can use clean energy stoves, they can use solar panels for lighting. But the most impactful of all those energy programs, and I hope Eric Naivasha is in the room, Dr. Joan, your team is doing well, is where we have peaked. The schools, our secondary schools, our universities, and our hospitals were using firewood to power their kitchens. And in 1 year, these schools, universities, and hospitals were cutting down 12 million trees. The bulk of the big schools now have been converted to use LPG. So as we support environment by planting 35 million trees, a target of 35 million trees, 21.9 million trees having already been planted, we'll be saving 12 million trees every year, which could have been cut to provide firewood to schools, to hospitals, to universities. That is what success looks like for equity. The bigger the capability for equity, the bigger the impact. So in a nutshell, we look at the impact of equity in the last couple of years, costing us $106 million. The bulk of it, 45%, going to Wings to Fly program, 32% going to the university and global scholarships, enterprise development, SMEs, 9%, health now picking up 6%, and we can see how health is growing, environment 6%, food and agriculture, which we are hoping to increase substantially, taking another 2%. So essentially that is the investment we are making constantly in society. And you can see that shared prosperity model in each aspect and how much has been spent. That is how we spend the money we make. That is the collaboration that we have with host communities that gives us the social license to operate by patronizing, investing back. The budget of Equity Group Foundation last year was 6 billion shillings. That's how big the spend for the foundation is. 6 billion shillings spent, and we have seen how that money is spent. Society continues to express confidence in the group, maybe because of the twin engine, social impact and economic engine, social and economic impact. We have lived to our calling and our purpose to be agent of socio-economic transformation of Africa. And we can see how we are playing into the two spaces. But we have been validated globally. We are celebrating, and we invite you to join us to celebrate the rating and ranking of Equity as the 4th strongest financial brand on earth. You imagine Kenya has been known of long-distance runners. Now it is known of its Equity Bank, which is the 4th best-rated bank on earth. You know, it's really a great achievement. And I invite our customers, and the Kenyans, and East Africans, and Africans, wherever they are, to join us in celebrating this great achievement. What others can do, Africans can do. What Western world can do, Africa can do. We just need to focus and build our own institutions. The Equity brand, just in the name Equity Group, is now valued 69 billion shillings. If you just sold the name alone, you would put in the pocket 69 billion shillings without touching assets. You have not touched any asset. You have just touched the reputation. In our African, one of our African proverbs says there is nothing more valuable than a good name. Equity has earned itself a good name. A brand is a name, a brand is a reputation. A reputation that can be given a price tag of 69 billion shillings speaks a lot about us, our values, our purpose, our essence, the way we do business, the impact we have in society, the way we treat our staff, the way we treat our customers. That is the reputation that has been given a price tag of, and it's great to have a Kenyan bank join the 500 largest brands on earth and be number 4. It is not number 500 or 499. It's number 4. We are working very hard next year to be number 3 so that we can also receive the award of the top 3. And the reputation continues. We have a very strong rating from Moody's. We have a very strong rating from the banker. So we continue to be evaluated worldwide. And we are glad that we do our customers proud. We do Africa proud. We do our staff proud and continue to stand out. And when you come to Kenya, the National Banking Awards, as we can see, there are 24 awards that banks share. Now, if you look at it, we are taking #1 positions in almost 18 awards. You go the contest with the 24 awards, you go with 18 home. That speaks about what equity is. This is the story that has never been told. And I've been told by the media that if it is not said, it hasn't happened. Today I have said it to confirm that it has happened. Because sometimes we have been focused more on doing and forgetting to tell people who we are. This is our introduction. We are equity. And we want to say, globally, we continue. Bloomberg, we are ranked among the top 50 businesses in the world. The Oslo Nobel laureate position. And the market also has given us a very good price. As you can see, we are 50 billion shillings more valuable than any other banking brand on the Nairobi Stock Exchange. And this is really what has given us a lot of impact. Let me say we have learned a lot from our twin engine, economic and social engine. The purpose was to give our people dignity and honor and expand opportunities for them. We have become bold and said, instead of focusing on changing lives, why don't we change Africa so that Africa gives every African a better opportunity? So we have crafted what we call the African Recovery and Resilience Plan. This is a transformation plan for Africa. For the last 40 years, we have focused on transforming the lives of our individual customers, giving dignity, changing lives, and expanding opportunity for each customer at a time. We have now said, why don't we change Africa once and for all? And that is what it is all about. We have seeded this plan to transform agriculture, to increase productivity in agriculture and mining, to use that increased output in manufacturing, to promote trade, and that's why we have been able to bring the Commonwealth East and Central Africa hub office to be hubbed by the group so that we can use the Commonwealth market to promote trade for Africa. That's why we have signed with the East African Community, SADC, COMESA, the African Continental Free Trade Area, to promote trade within the African region. We have seeded this plan with $6 billion US. We have managed to get support and commitments of another $24 billion. We try to induce transformation of the African continent. We are proud that we have taken this bold step when we are of age, but when the universe seems to have conspired to give Africa a chance. Africa has the youthful 1.3 billion labor force that can be put into use. Africa has a unique opportunity of holding 60% of all unutilized arable land that can lead us solve the world food security challenge. Africa can be home for diversification and decentralization of what the world has come to appreciate, that it can't continue to rely on a few countries. And as a result, this plan has managed to get a lot of consensus around the world. And we are working on it to roll it out, to support our customers to be the agents of implementation, because it's a business plan, transform Africa from the communities, from the business perspective, and we are very confident. The outcome of this plan will be look like 50 million young people get jobs from the businesses that will be focused on. 100 million customers will have been reached. Agriculture, manufacturing become major sectors of our economies. Manufacturing become significant, and Africa matches its population size as a percentage of global population, 17 with the GDP. The objective is to reach 17% of the world GDP to be funded in Africa. I'm humbled by the support we have got around the world, and from a pictorial point of view, the sign-up of the Commonwealth to be part of this discussion, to be part of the implementation has been very, very humbling. That wherever we go, the support of these projects, winning trust globally, speaks a lot, because it's all about trade and investment. And we are supporting massive trade and investment opportunities. So broadly, that is how we are going to enhance the social pillar. Now, while focusing still on the individual, that the individual must be granted their dignity, they must be given a chance to transform their lives, they must have an opportunity to expand their opportunities. A transformed Africa would do that in one go. And so why not transform Africa instead of focusing on the individual? And that's the African Recovery and Resilience Plan. That is what equity is all about, a human story. It's not about numbers. But this human story manifests itself in numbers. Customers deposit, customers loans. That is how the activities are measured. They are measured through a currency. So allow me to take you through the balance sheet of equity. And the balance sheet of equity has grown to reach 1.447 trillion shillings. It grew by 11%. And as we can see, it is driven by loans. Loans grew by 20%. During that very difficult period, we continue to support our customers. We continue to roll out. We won the trust of global financiers. Our long-term loans grew by 23% to support us to fund manufacturing. And our shareholders' funds reached an all-high time of 182 billion. That has netted off 44 billion of mark-to-market, so that everybody knows that how we have accounted for mark-to-market. It's already marked, but we can see the big base. But the better part of this is not the assets we hold, it's what we do with the assets. So lending contributed interest income of 119.6 billion, interest income growing by 27%. Paying depositors, next slide, Alex. Paying depositors, 33.6 billion shillings, whose interest grew by 32. So I hope our customers can understand why interest rates have gone up is because interest that we pay depositors have gone up. We can see the growth in interest expense is faster than even in the income. So net interest income grew by 25%. The non-funded income, which we said is our focus, grew by 33%. Net interest income growing by 28% to 144.3 billion shillings from 112 billion shillings. And we say part of that 144 billion, 13.7 went to provisions, 24.8 billion went to staff, operating cost took 46 billion, total cost of 84.5 billion, growing by 39%. Costs are growing faster than total income. Profit before tax increasing to 60 billion shillings, a growth of 15%, and profit after tax growing by 15% to 46 billion shillings. And as a result, the board has recommended a dividend payout of 15 billion shillings, increasing dividends by 33%. This is intended to support our shareholders during this very difficult macroeconomic environment so that they can look after their families. So the earnings per share has gone up by 15% to 12 shillings per share, and the dividend has been declared at 4 shillings per share, or recommended at 4 shillings per share, so that the customers can take themselves. This story of equity is a consistent story. If we look at this story of equity, and I want to take a few minutes to give confidence that if the financial crisis, equity will wither it, the way it withered the interest capping shock, the way it withered the COVID-19 pandemic. Interest capping was effected 2016 and was lifted 2019. But look at what happened to the deposits in equity. They still grew from 300 billion to 500 billion. Loans still grew from 266 billion to 366 billion. Total asset during that period grew from 474 billion to 700 billion. And profitability of the bank grew from 25 billion to 32 billion shillings. Shareholders' funds from 81 billion to 150. But look at customers. 3 million customers joined, new customers joined the equity during that trying period. Then COVID came in 2020. Immediately after 2019, we entered the COVID season up to 2022. Look at what happened. During COVID, the funding of the bank more than doubled from 500 billion to 1.2 trillion. Loans from 366 billion to 706 billion. Total assets more than doubled from 673 billion to 1.447 trillion. Profits from 31 billion to 60 billion, again doubling. Shareholders' funds from 111 to 182. Look at customers. During COVID, equity opened an additional 4 million customers. During interest capping and COVID, the bank increased its customer base by 7 million customers. That's the story of equity. The story of resilience. It's all about resilience. And hopefully, in the fullness of time, people will learn how we should manage our businesses. And that's why I have a lot of esteem on our management team. And I want to assure the public, the customers, the shareholders, the analysts, the way they managed interest capping, the way they managed COVID, they will also manage the economic crisis and the financial crisis. It's the principle of decision making. It's the quality of decisions that you make. The most interesting thing is during this period, the management didn't have to go back to shareholders to say, give us more capital. They balanced payout and funding the business from internally generated funds. That growth, if you look from 2016 to 2022, a period of 5 years, the balance sheet has grown 4 times. Funding has grown 4 times. Profitability has grown 3 times without having to go back to the shareholders. This management is able to balance internally generated funds. How much do you pay shareholders? When it's easy, pay for. When it's challenging, you need to fund the bank. And has been a very conservative management that can, and prudent, let me use the right word, a very prudent management that it knows that buffers is the way to confront shocks. If you look at our capital buffers, and we shall look at the the ratios. If we look at our provision buffers, the quality buffers, that is how you manage a quality bank. So let's look at the ratios and the strength of the bank. As we can see, yields are going up on earning assets, cost of funds remaining broadly constant. So you look at the dividend payout ratio. For a share whose par value is 50 cents, you are paying 4 shillings, a multiple of 8 times the par value. A dividend yield of 9%, and an NPL coverage of 94%. That is really what. And the most important thing at time of turbulence is capital. Look at the ratios of capital. Moved from 12.9 to 15.6, and risk to weighted assets from 17.7 to 20.2 to be one of the most capitalized bank, or the best capital ratios in the market, if not the best. And liquidity ratios, one of the best, if not the best in the market. That is what prudent management is all about. That is what competence is all about when you have a highly competent management and leadership. And lastly is to look at how the subsidiaries are maturing. If you look at the return on assets and return on equity, almost now the group is almost equal to Kenya. Kenya has stagnated, but you can see the group is going up. It means the subsidiaries are coming to the same level with Kenya. It's now one big bank. We will no longer be talking of Kenya and subsidiaries. They are now mature and contributing to the family like Kenya has contributed. Let me summarize what we have said, the highlights of 2022 full year performance. It's a record 59.8 billion shillings, profit before tax, a profit after tax of 46.1 billion, a 15% year-on-year growth, a 33% growth in dividend payout to 15.1 billion shillings, a record Kenya shillings 1.447 trillion balance sheet after 11% growth in total asset, a record deposit base. For the first time, equity exceeded 1 trillion shillings of customer deposit after a 10% year-on-year growth, a strong cash buffer of 16% of the entire balance sheet, equivalent to 232 billion, giving agility to the bank, a strong liquidity buffer of 52%, a high asset quality of 7.7 against the industry average of 13.3, a 94% NPL coverage, and 123% coverage inclusive of credit risk. And when you look at the future, the basis of projecting the future is not the past. The past is what it is. The future will be determined by the fundamentals. What are the fundamentals of equity? A very strong capital buffer of 182 billion shillings, 15.6% core capital to total risk weighted against a minimum of 10.5. Look at the buffer of 5.1%, 50% above the minimum capital requirement, and a total risk weighted of 20 against 14.5, another 6%. A strong deposit and liability franchise. Look at the cost of the franchise, and a strong market confidence as reflected by long-term debt of 157 billion. Capital and long-term debt accounts to 340 billion, equivalent to 23% of the entire balance sheet. and a deposit to loan ratio or loan to deposit ratio of 67. These are the fundamentals upon which the future will be built. Look at the strength of the character of Equity as a financial institution. The strength of a bank as a bank. A strong momentum of non-funded income growth of 33%, and I'm told we'll surpass this year. A high quality earnings, non-funded income contributing 40%. Strong efficiency, cost-income ratio, and high digital adoption, giving opportunity for fixed cost reduction variable. That is what the future will be built on. This, for those who want to invest in equity, this is the most important slide. But if you can't interpret this slide for what it is, let me give you a prediction of what the future looks like. And you can compare the outlook and the outlook for last year. What we had predicted, what the actual is, and then the basis of predicting the future. We are projecting a very strong future despite the turbulence in the economy. We expect a 25% growth on loan book, like we have sustained in the past, growth in deposits, net interest margin to improve, non-funded mix to improve, cost-income ratio to improve, return on equity to improve, return on asset to improve, cost of risk to improve, NPLs to improve, and our subsidiaries to improve their performance and also mature, and almost all of them reach a 4% return on equity and hence contribute 50%. That is the future as we see it, informed by the fundamentals of the bank. And I want to close by thanking our board for its leadership, its foresight, its oversight for the bank, and the management for taking the challenge to really build an iconic African banking institution that stands shoulder to shoulder with the best the world has ever produced. Thank you very much for your attendance to this investor briefing. Thank you.
Thank you, Dr. Mwangi. We will now invite members to ask questions with the areas that they require clarification that Dr. Mwangi and the team that is on the podium will address. Questions?
If I understood you correctly, Dr. Mwangi, you were emphasizing again and again that equity is not Silicon Valley Bank or anything like that. So much so that you said that your asset portfolio and quality is pretty much diversified and of high quality. So could you drill slightly more on your large and corporate assets, which you said are at 60%? Drill slightly more on their how diversified. They could be deep, but how wide are they? On your social engines, I don't see you to be very keen on TVETs. What would you take for you to put a bit of your money also on TVETs, given that we've been told that there are clear skills gaps in our job market, which TVETs can plug in? Thank you.
Thank you very much, George. Let me start with the second question. As Alex, you tried to get me the slide on loan distribution. I think quality of loan book. In terms of the current, our social impact programs are driven by the needs of society and the level of evolution. You are spot on. The past is what it was, but the future, technical skills, life skills will be more important. If you look, that's what we have been trying to do to young people. They may not be TVET, there have been entrepreneurship training. If entrepreneurship training is what would be given in a technical accounting, a technical institute on how to do the life skills of the job, doing the job. I didn't want to talk a lot about what we have not done, but at the moment we have teamed up with the global technology companies to try and build the 3 million technology skills to our young people, whether it is coding, whether it is all technology skills. And Marshall is here, is leading with the global technology companies, because Africa will not transform without those technical skills. I'm also informed, Beth, you have 3,500 students in TVET. So we have started to do the learn, because what we didn't require is high quality plumbers, high quality welders, high quality electricians. That is the skills that the country requires. So we have piloted that with 3,500 students. We are now going to technology, IT skills, so that we can fill the gaps that are there globally. But you're spot on. These programs evolve as society evolves, as community evolves. We address the needs of the time. At that time, what is so critical? In terms of loan development and distribution, it's clear it's the other way around. Retail banking is 60%. Medium and, it is there on the slide, medium and large enterprises and corporates are only 40%. But remember, we are focusing on a transformed Africa. Equity doesn't acquire large and corporates from the market. They graduate. They reflect the success of equity in nurturing talent, in supporting micro, small, and medium enterprises to graduate. So these are not customers we don't know. They are customers we have had maybe for a cycle of 30 years. We have grown with them, and they have grown. If you look at, and I can give you a few examples of which we are very, very proud of. Look at Mount Kenya University. We started with a 40,000 shillings loan to prepare a class for evening classes, remedial classes. Today, Mount Kenya is the largest university in East and Central Africa. It has grown from an evening class to a medium college, to a large college, to a large corporate university in the region. So you can see that is in the education space. You look at Equity Afia, 78 health hospitals. So when you look at Equity Afia, it's a corporate hospital. It's, if you look at hospitality, if you look at most of the hotels in Naivasha, we have funded them. Again, they are medium-sized hotels. If you look at farming, as we said, 400,000 are medium-scale farms. So essentially, it is very well distributed, as you can see, in all sectors. There is no sector that we, and that is the strength of equity. It spreads against all the sectors. That is how we mitigate our risk. All segments and all sectors. That's how you mitigate the risk. You go to agriculture, it's all crops. Coffee, tea, dairy, cereals, because they respond differently and they are in different ecological zones. The same with the businesses. If you look during COVID, one of the sectors that did very well is agriculture. Another one that did very well is retail, the consumer, FMGs, because whether people are at home or in the office, they have to eat. So essentially, we have diversified our offering so that you manage the shock within the portfolio. Thank you very much, George.
Okay, good morning. Dennis Otieno here from Citizen TV. For my question, I don't think you'll need a slide. In terms of the street demos that have been ongoing in the country, what sort of impact has it had on your business operations? We've seen some firms resorting to closure of their businesses, and also others, reducing the number of staff during the days of the demos. So has there been any impact from where you sit? Thank you.
Thank you very much. From an equity perspective, we have all been reporting to the office. Yesterday I was in the office, all staff, because we anticipate we shouldn't inconvenience our customers. However, it is, as you have observed, a number of businesses never opened, so the number of transactions in the branches will go down. We saw data from Nairobi County saying that they had lost 50% of their revenue collections, so it would mean that such a customer would be banking 50% of what ideally they would be banking. However, as a group, we are fully digitized. So we still see that the customers of equity are able to transact if they need to, because we have digitized cash, and we have been able to integrate the digital layers with the retail commerce through Pay with Equity. We have been able to make our system interoperable with other systems like M-Pesa, so people are still able to move money. We're able to originate loans, so the loans will kill, but there will be people who would be borrowing and borrow early in the morning at 4, so that they can go to the market. If that day they are not going to the market, then we'll miss that. It's too early for us to quantify and to have a clear picture, but truly there is disruption on economic activities, which is very regrettable. And hopefully a solution will be found, or a better way of dealing with disputes as opposed to disrupting economic activities, while our livelihoods are supported by economic activities. Thank you. Let's then deal with a few questions. Yeah. We'll come to you, Mr. Shem. I just wanted to answer 2, which are online, and then come to you. Thank you. There is a question here online from Patrick Alushura, Business Daily. What is your view on the problems facing U.S. banks? Are you concerned for local banks in light of the heavy exposure to government bonds as value comes down? I'll give that question to our chief strategist, Brent. Brent, I will repeat the question for you. What is your, and maybe also Yvonne, our chief economist, also complement this question if you can give a mic to the 2 of you. What is your view on the problems facing U.S. banks? Are you concerned for local banks in light of their heavy exposure to government bonds as value comes down? Brent?
So maybe just to give a bit of color on what's happening in the US if you're not familiar. So the US started increasing interest rates early last year as inflation started to pick up, particularly post the Ukraine-Russia war on the back of higher commodity prices, and also further because of the stimulus that was given during COVID, which is now being deployed, driving aggregate demand globally. With the higher interest rates, these interest rates have increased about 500 basis points in less than a year. What has taken place during that period was a lot of banks sat with a lot of liquidity during the stimulus that was given across the US banks as well as globally. And with this excess liquidity, a lot of the banks invested in government securities. In particular, they invested in long-dated government securities. But The challenge for the banks that have failed in the US, which there have been about 3, it's largely driven by the funding side, where deposits were highly concentrated and access to liquidity was somewhat strained because of the levels of exposures to government debt. So, as James highlighted, our balance sheet is well diversified. He mentioned the levels of capital. He mentioned the levels of long-term funding, which is equivalent to around 10% of our balance sheet. And you'll appreciate we have a well-diversified deposit base. We are an 18 million deposit bank, with a large part of that in the mass market. So that gives you a sense on our funding side. On the asset side, we have put a bit of it into government securities. We have reflected the mark-to-market in our capital. Again, importantly, the reasons why the 3 banks have failed, as well as the rescue or the buyout of Credit Suisse, was because of liquidity issues triggered by a credit event on its bond portfolios and other assets. So in terms of our system, I can only speak confidently about our bank. I don't have purview of our peers, but what I can say, if we look at the interbank market, these are functioning relatively well. The central bank does publish interbank rates. You'll see the interbank rates, particularly when you look at the lowest interbank rate versus the highest interbank. There is no divergence in those rates. It's important to highlight this because if there are banks struggling, you'll see a divergence between the highest and the lowest. The lowest reflecting the interbank activity of the large banks, and more often than not, the highest rate reflecting the dynamics between the small banks. There is no divergence if you look at the central bank data to date. And over the last 2-3 years, divergence has been very minimal. And you can compare that back to 2016, which if you've been looking at the Kenyan market, you would have seen a divergence back then. So from those high-frequency data that the central bank publishes pretty much on a daily basis, we are comfortable of our position. And from what we are seeing in activity levels in the sector, they seem benign, at least for now. So I don't know, Yvonne, if you have any further comments, but...
About impact in the banking sector, I'll speak to how I see the impact playing out on the macro. So as has been mentioned, we've seen a significant tightening in monetary policy over the past 15 months. In my view, recent developments in terms of the turmoil in the banking sector that we're seeing in the US and Europe does imply that we will see some slowdown in terms of lending in those particular economies. So just to give context, the tightening we have seen in monetary policy was anticipated to slow economic growth this year and to subdue inflation. We do think the turmoil in the banking sector will also add to those drivers. So we should see some significant slowdown on the back of it, as well as inflation coming off, implying that the turn in the interest rate cycle may happen sooner rather than later. By that I mean we'll start to see peaking of interest rates happening sooner rather than later. So this month we have seen the major central banks globally continue with the tightening as inflation remains the most immediate risk. But we are seeing analysts begin to price in cuts in interest rates from the beginning of 2024, implying that our economies may begin to follow suit in that timeline. Thank you.
Let me take advantage of Patrick's question to really address our customers in what I would call the customer's language. The reason why US banks are having challenges is because we are coming from an era of very low interest rates. Interest rates in US have been below 1% for maybe 10 years. The US government pumped in 80 trillion US dollars during the COVID period. President Trump pumped $6 trillion. President Joe Biden pumped $2 trillion to support the economy. But people were not spending that money. That money was being deposited in the banks. Now, the banks took that money and invested in government bonds at rates below 1%. Then inflation came, and the US Fed Bank increased the interest rates. I think they are now at about 5%. So you are holding a bond at less than 1%, and the market interest rates are at 5%. When you look at mark to market, it's more than 90% of the value of the old bonds. And that's where the problem arose. Now, let's come to Kenya. And that is true of Germany, where interest rates were negative. It's true in Japan, where interest rates were negative before. But come to Kenya. The treasury bonds were 9%. Treasury bills were 9%. Treasury bonds were 12%. Look at where they are today. They are still 9 and 10. So there is no mark to market at the moment because the interest rates haven't spiked, because mark to market is because of very rapid change in the offering of new bonds. So the differential. And so you will not see any meaningful mark to market being registered. The prediction is that we are almost reaching the peak of inflation. So by 2024, interest rates will start coming down. So are we on the tail end? I'm not sure. I was surprised that the Fed, despite the failure of the three banks, it still increased interest rates, making the situation worse in the US. Europe even increased by a higher margin. Why? They are more concerned about inflation, not interest rates and financial systems. It's really a focus. So in Kenya, I don't see a mark to market. The banks that have registered a mark to market are the ones that were holding euros. And as at December, the Eurobond had the worst yields of all the way to 17–18%. As since then, come down to 11. Now it's 14. So, but essentially, the mark to market now are much lower than they were in December, because so I want to associate myself with the authoritative statement that was issued by Moody. I may not have a view of the position of the balance sheets of the banks, but Moody 2 weeks ago issued a statement to say the big Kenyan banks, they used the word the big Kenyan banks are okay, and they don't see any risk to them. I would like to associate myself with that statement. That looks okay. Now let's go to the next question. What is your opinion on the state of interbank Forex market? Yvonne, do you want to take that? As Yvonne, for Yvonne, I will repeat. What is your opinion on the state of interbank Forex market? Gashau, has you come back? Gashau, our treasurer, had a meeting with the central bank in the morning. That's why I'm asking the chief economist to answer. What is your view? It's a personal view, so you don't have to.
Well, I think the fact that it's not functioning as it has been has added to the tight liquidity we're seeing and this depreciation we've seen of the currency over the past several weeks. So while fundamentals do suggest, and I think I'll speak mainly to the fundamentals, fundamentals do explain why we've seen pressure on the currency, including the fact that we've seen reserves come off quite significantly. We're sitting at around $6.5 billion in usable reserves. You've got import cover at 3.8 months, and we're coming from around 5 months, 15 months ago. That does reflect a deterioration in the external position. But I'd imagine that as the interbank market, FX market, as the functioning resumes, that we should stop seeing these spreads or a deterioration in terms of the exchange rate going forward.
If I add to just, I've observed since the deputy governor called the banks, the top banks, 7 of them that control 80% of transactions, sat and said, can we bring back the Forex interbank? And since then, we have seen it function. It has been almost 1.5 weeks. And what we have seen is some semblance of stability in the interbank, and not just in the interbank, in the Forex. They averted the continued devaluation of the Kenyan seems to have abated from the interbank rates. Perspective, the government has come in to support in a structural way. And we anticipate that the head of the April fuel cost will be paid in Kenya shillings by the oil companies. And the government will take the responsibility for the Forex after 6 months. It's my hope that the 26% of Forex demand that was for payment of oil purchases by oil company will lead reverse demand. And once demand is reversed, then hopefully if supply remains constant, then we'll see either stability or strengthening of the Kenya shillings. But I'm glad we had been asked a personal opinion. The third question from Patrick is on the Spire Bank deal. What was the total settlement from Walimu National Circle in matching the asset and liabilities required? I will give that question to my colleague, Mary Wamai, Executive Director, who we had given the responsibility of that. But say we felt honored that we could be called upon to provide a national solution. Spire Bank was not your normal way transaction of acquisition or mergers. It's where a strong bank in the market is asked to solve a market problem, a Kenyan problem. And so we stepped in to solve that problem in a way that the depositors and the financial sector were not adversely affected. Mary?
Thank you, James, and good morning, and good to see you all. So first of all, can I just confirm that the Spire Bank deal happened after the year end, because we closed it on the 31st of March this year. So you may not see any of the numbers reflected in the financials that we have just looked at. That notwithstanding, we were very lucky that we were able to successfully conclude the deal. And at the end of it all, we got an additional new depositors or customers, deposit customers of just slightly over 20,000 deposit customers, just about 3,000 loan customers or borrowers. The total deposits that we acquired as at 31st of January 2023 was 1.3 billion Kenya shillings. The loans taken over totaled about 900 million Kenya shillings. So the bank received in cash the difference between those two amounts, which works out to about 400 million Kenya shillings. So that was the total amount the balance received on that transaction. And I'm also happy to say that we were able to successfully take over and onboard those customers, and the team worked very hard in credit, operations, digital, cards, etc., etc. And I believe they are being serviced like any of our other customers on all our channels. Thank you very much for that.
Thank you very much. Maybe just as we said, we didn't acquire Spire Bank. We acquired some assets and liabilities. So the assets we acquired was customer deposits. As Mary said, 1.3 billion. So those customers, we brought them into our books and credited the accounts with 1.3 billion. Spire Bank then gave us loans, but they could only give us loans 900 million. So we said for 900 million of depositors, we have received loans, we will continue collecting, but the customers can take their deposits. The difference between the deposits we had to pay out and the loans we received is the 400, and that is what was supported in cash. So there is nothing that was being paid into equity. It is deposits 1.3 and assets 1.3. So assets were made out of two classes of assets, a loan book and cash. So that's broadly what it was. The next question, Dr. Joan and Professor Macharia. Professor Macharia, it's good to ask a chairman to answer a question. It comes from Eva Jenga. With the very impressive growth of Equity Afya, is there a possibility of the group getting a level 5 or level 6 hospital with a possibility of a center of excellence that can provide research and training for health professionals? Professor Macharia. Professor Macharia, as we said, is a professor of medicine. He's a surgeon, ENT, and he's the chairman of the group board and supports us a lot in the foundation in the pillar of health. Professor Macharia.
Thank you very much, James, and thank you for that question, Eva. I think we need to reflect on why did we, as a group, support the development of Equity Afya. As James said in his presentation, we found that health crisis is a major contributor to our customers failing to honor their obligations. And when we looked at how can we, as a group, respond to this challenge, we realized that there is a dire need in this country for affordable, quality, and accessible healthcare, where you have predictability, and where you have, we use the economies of scale to pass the benefits to our patients, clients, as it were. And also to use a centralized quality control system that ensures that any patient that attends an Equity Afya clinic anywhere in this country will expect the same level of care. And we have been vindicated because the average cost of consultation in the Equity Afya clinics is about 40% less than equivalent facilities in the country. We have a very strong quality control system, and we have found that we are able to maintain our quality. In addition, despite the fact that the cost of consultation is lower, all these clinics have broken even, and the medical entrepreneurs are making a profit. but they're making a profit which is very consistent with the philosophy of the group. They are providing a service, they are impactful, and in engaging in their services, they are very much community-oriented. As to your question, we are customer-driven. We respond to the needs of the community. We need to be able to establish a national footprint, and then we can start thinking about level 4, level 5. And this will be a natural occurrence because the patients that are seen in the clinic will eventually need a level 4, level 5, level 6 hospital that will give them the same quality of care at affordable rates, and that this hospital or hospitals will also be accessible. So naturally, we would not want to climb a tree from the top. We start by establishing a national infrastructure, and then from that, we will move on to, because we want to be a major player in the healthcare sector, the same way that we disrupted the financial services, we are looking forward to disrupting healthcare in a positive way. Thank you.
Dr. Joan, is there anything else you want to add?
Thank you very much, Professor Macharia. I think Professor Macharia has captured the sentiments, but in summary, we are building the health system upwards. You know, the Equity Afya facilities operates at 2 levels currently. Our satellite and spoke facilities are at level 2. Our hub facilities are level 3 facilities. So we are building upwards. Our target is to go to the primary inpatient care, which would be level 4, and then build further upwards to level 5. It's also in keeping with what Dr. Mwangi had indicated in terms of addressing their customers at the point of their need. If you look at healthcare seeking currently, and speaking to our insurance partners, they'll also tell us majority of healthcare services that are sought at the outpatient level, up to a minimum of about 70%. So the remaining 30% are the inpatient care facilities, which means we need to address outpatients first and get that right before we can scale into inpatient and further upwards, even towards tertiary care and even research. So it's a long-term pathway that we have. Thank you very much.
So to make health affordable, as Professor Macharia has suggested, we have approached it from a 3 distribution channel perspective. At the satellite level, we have a nurse who is helping community and really providing preventive care for community. And there we might pay them by capitation. At the next level is a clinical officer who then can get referrals from the nurse. What the nurse can't do preventively, they then refer them to the next level, maybe at slightly above the village. Maybe the nearest town center is a clinical officer who then can deal with this, right? Then the clinical officer then refers to the doctor who is at the hub. So we have, that's what Dr. Joanna said, we are doing those 3 phases, and then say what are the lessons we have learned, what kind of hospitals do we need to do. But as Professor Macharia said, you can trust that Equity will go the whole journey, the whole hog, eventually will provide comprehensive health to this region. The second aspect is that Equity, whatever Equity provides in Kenya, will provide in other countries. So this year, by June, we are trusting we'll have opened 30 Equity Afya clinics in DRC because there the need is even greater than Kenya. And when Kenyans travel, like we took 300 of them for a road show, business trade mission, we want them to get to have health access wherever they are, our customers in DRC. So it's a long-term view to disrupt and transform health fully. What has really impressed us most is how quickly that concept has been picked globally. We have an international company that has come and said, yeah, you have addressed the needs of the middle income. Can you address the needs of the very poor? and they have given us 1.5 billion shillings to 1.7 billion shillings to establish equity afya clinics in the slums and the remote areas. So we have started doing that. Even to pilot test in DRC, that whole cost is funded by a donor who says, we saw what you did with education. We don't want to be left behind, and we don't want to wait for too long. Scale this thing. We have also had a visit from Manchester University and said, can we start doing research together so that you get the benefits of information. Last year, we received 1.3 million patient visits. Now, you can imagine the amount of data we have that we can analyze with an established university like Manchester. John Hopkins have also called, can we start working together? Eventually, we believe we are, and we have started receiving calls from the largest global pharmaceutical companies saying, we can see what you are doing. Can we partner with you? We provide you with requisite drugs. And the question is, why don't you come and set the pharmaceutical factory here in Kenya? We are big enough. So you can see how EVA, it's likely to generate. It's likely to create a cluster. The way we did cut flowers, then developed an entire cluster, health cluster. This is going to be. So there will be level 4 hospitals. I think the hubs are level 3. Level 3, so there will be level, and I think that discussion has started coming and playing. There may be need to set up maternity wards, which can really relieve, so that, and they be supported by these really hospitals that can be handled easily, and then we'll then hope for it. My hope is that in the medium term, Professor, we'll have centers of excellence for cancer and all these chronic diseases. Instead of setting patients to India, US, we then get these specialists. The good thing and most comforting thing is that we have a pipeline of 1,800 doctors. And what we have seen is that the old doctors, we have started sending them for specialization. And most of them are going to global hospitals, global universities to study. So essentially, we are building the skills that will be necessary. Thank you, Eva, for such a good question. Steve Shege from YouTube. With 97% of bank transactions happening in the alternative channels, do you expect to see opening of more branches? It is true, branch is an alternative channel, and we have realized human interaction will always be necessary. When we open agencies, when we open equity, pay with equity merchants, they need to be supported. The best way to have these alternative channels is to branches. When you talk about equity affair, the best way to support equity affair beyond the platforms is in a branch where they can be able to buy health insurance program, equity affair insurance policy through bank assurance product. So these alternative channels, we have quickly realized, needs to be helped by a channel that is human-driven when people want to consult. The second thing, as we saw, 40% of our customers are now large and corporate. They are growing. They require advice. They require consultation. They need to have human relationships, because that is more relationship banking. There is then need for branches to host such relationship managers. Steve Shege asked about the dividend. Sorry, this is Dickie John. Dickie John, about dividend, let me repeat. The Board has recommended a dividend payout of 15.1 billion. That is 4 shillings per share, up from 3 shillings at 33%. And it's 8 times the par value of the 5 cents share of equity group, and a yield of 9%. So then Steve Shege, another question. Impressive performance, primarily driven by interest income and non-funded income. After the regulatory approval on risk-based lending, what has been the effect in growth of asset book? Mary, do you want to take that question? Let me repeat again. Impressive performance, primarily driven by interest income and non-funded income. After the regulatory approval on risk-based lending, what has been the effect in growth of asset book? And then Brent, you can answer also from the forecast. What is the outlook?
Thank you, James. Just to confirm, yes, as of 1st January of 2023, we did reprice our loan book based on the risk-based pricing model that was approved by the central bank. This is in line with what we've been seeing in the environment with the rising interest rates. As the cost of funds go up, we do need to price the money that we lend out appropriately, and that repricing applies to both the existing book and the new loans that we are bringing on. Have we seen that impact the growth of the loan book? No, we have not. The shift that you're seeing in terms of a growth in NFI, more than the NFI is growing faster than our funded income, and that's because of the environment that we're operating in. There's a very strong focus on digitization of our services, on lending via digital channels, and this is not the 1-month digital lending loans, but this is our products that we offer our customers regularly in the branch, but offering this more conveniently through digital channels. You'll see that is giving us faster turnover. There's a lot of FX income growth. We are emphasizing a lot more on non-funded income growth than we are on funded growth. But there's still a lot of demand in the market for these loans that is going through the proper credit assessment procedures. So there is no direct impact on growth based on this risk-based pricing.
So maybe just to add to the outlook and what it implies for growth going forward. So since 2016, you would have seen consistently our loan-to-asset ratio has gone down. This was an intentional decision by management to reallocate its balance sheet, particularly in Kenya, and Kenya at the time was more than 60-65% of the group balance sheet. This was obviously on the back of interest rate caps where we were not able to price for risk, and the number of borrowers that we had declined because of our inability to price for risk. What you will see going forward, and what you've seen in this set of results, although we haven't yet started pricing for risk, is that you've seen a reversal of that decline in the loan-to-asset ratio, where we're now at 49%. 2021, we were at 45%. This is reflective of our strategic intent to reallocate our balance sheet to the private sector. This is across all our subsidiaries, from Kenya to DRC and across the other 4. So what we are guiding for is that we will see loan growth coming back. You'll see historically, Equity Group has grown its loan book more than 2 times nominal GDP. Nominal GDP at the moment around 11-12%. We're guiding for 25 to 30% growth across the group. And you'll appreciate that in the high growth markets of DRC, Uganda, Rwanda, and increasingly where we see Tanzania stabilizing, you will see growth coming back. And importantly, to the question for Kenya, we can price for risk. Our number of borrowers will increase, the value of loans will increase per customer. So that is what you will see. Thank you.
And lastly, Steve, Shege, on that question, we talked about now transforming ourselves into a development bank. And we have said we are seeding the African Recovery and Resilience Plan with $6 billion. So that's money we have put aside to say we want to see productivity gains in agriculture. What is it that we need to finance so that agriculture transforms? We believe we can increase productivity 3-4 times. We also believe that with that increased output, then we need to finance agro-processing. We need in DRC to help the country move from exporting oils to value adding in its natural resources. That value addition in natural resources is significant. The agro-processing and value addition in natural resources means setting up a manufacturing capability in Africa to add that value. That industrialization is likely to consume significant loans. That's why we believe that funding of $6 billion is not sufficient. It may not be long-term enough that manufacturing will require. That's why we have talked with 16 development banks who have committed $24 billion. And then we are saying we'll promote a lot of trade globally. You can't become industrialized without exporting. Trade, finance, and other trade capabilities will come in as form of soft trading so that we can promote trade. Intra-Africa trade, Commonwealth trade, and global trade. So all that is opportunities. And we expect by 2030, equity will have been transformed by our African transformation plan. You can't industrialize Africa. You can't take the responsibility of transforming Africa without yourself being transformed. You must transform yourself. And as you have seen, we have transformed our human capability, the skills and the competencies, people who have managed this before. This week, for instance, we have welcomed Rene, who was the chief operating officer of JP Morgan in US, because the capability is US companies are coming to set manufacturing here. They should be handled the way they are handled in US. David joined us from Amex, is our group financial controller. So that is the capability. People like Yvonne, who was the chief economist for Renaissance Capital. From an investment perspective, she can do research for our customers. She can do notes to our customers on microeconomic environment. We can then complement Brent in terms of analysis and advice. So we have completely transformed our capability. And I'm seeing Marshall looking at me and saying, James, why are you not saying we are also overhauling the entire systems of the bank? The IT system are all being overhauled so that we build the bank of the future, powerful systems that enable the customer instead of what we have been doing gradual onboarding. So that transformation will have that. I know, Chemi, you have a question. You have been joined by Jimmy Bogwa of KTN and Ochieng Olo. So do we start the reverse way, Ochieng, Jimmy, and then Chemi?
Thank you. My name is Ochieng Olo, Think Business. Why is equity, no, let me rephrase. Is equity angling for some of these big ticket business projects that are being banded by the government? I have in mind the attempt to reduce the cost of living through Kenya National Trading Corporation, which is costing billions and billions of shillings. In fact, perhaps a lot of money for just one bank to handle. Then there's a government-to-government importation of oil, which is also quite a bit of money. So is it that you are not sitting at the table where these deals are being negotiated, and if so, why? Yeah, is this something that you think would make sense for a bank your size? I mean, if somebody's going to look for size for this project to be handled, you should actually be sitting at that table. I said I don't know if you are, so please tell me if you are. Now, the other thing that I wanted to ask, a very small, quick question. Why is the interbank Forex market not working? You explained that it is going to be working, but why has it not been working? Is it something that an expression of some displeasure by the big players in the Forex market, or what is it? Thank you.
Thank you very much. The first question is maybe answered best by what the purpose of the bank is. Remember, we have focused all along since our beginning on changing lives of our people, giving them dignity and expanding their opportunity. That purpose and really great focus on that purpose made us really become a private sector bank. And you saw our numbers. Only 6% of our loan book is in the public sector, because we know we were created by communities, the rural communities, now the urban communities, to address their needs. So we have never been detracted. We have been focusing on lives and livelihoods of our people, dignity on our people, expanding opportunity, training them, capacitating them. And so there has been a bias towards the private sector. So if you see us missing, it doesn't say anything about it. It says who we are, where we are coming from, and heavily ingrained in community. We now hear what the community is saying. We have done very well in changing each of us. Why don't you change our economies? And that is where the African recovery and we have committed money. So with committing 6 billion, our hearts are full. So we know we are just one out of the 39 banks in Kenya. So we can say, why don't we do what we do very best and really fulfill the promise we have given to the Kenyan people that will truly transform Africa by funding the private sector. Remember, the commitment is to fight the private sector, to increase productivity in agriculture, in mining, to go into manufacturing, to go into export, to formalize the informal sector, to populate those value chains, to generate clean energy so that industrialization is clean energy, to bring technology so that we leapfrog on technology and future-proof, use the fourth industrial technology. So that is more of an obsession. And it looks like equity, once we focus, we really focus, we are deliberate and intentional. So it may say nothing else other than who we are. In terms of, again, big tickets. Remember, we started with the city council workers. We then went to Gekoba, then rural areas, the small farmers. The people in Gekoba have now become medium enterprises. The farmers have become medium-scale farmers. Some farmers have become agro-processors. And that's how we have now created medium, large, and corporates. Equity itself has become a corporate because its customers have started becoming corporate. It has become large because its customers have become large. We are an aggregator. So we are able to create big tickets for ourselves. So again, we will not be looking. We stick to the principles. We stick to the strategy, and we haven't been detracted as such. I think you had a second question on why do we think the interbank Forex market will work? Because the central bank and the treasury has teamed up together and invited the banks. It failed to work because we were not working together. We allowed the markets to establish two rates, the central bank rate and the market rate. The initiative now is to bridge and to close the gap between the two. We are working together. We are meeting, like that's why our treasurer, I hope he has come, Daniel Gashau, not yet. You can see they are meeting twice a week, and really keep on improving the market. It's a public-private partnership, and we can sense it has started to work. The volumes are coming through. The government is giving us the projections of how to abate some of these. So we think that the reason why it is working is because it's a public-private partnership. The actors have been brought into the market, and the central bank has decided to provide leadership. I think initially it has observed the market to operate on itself, and we all know about market failures. So I would say this is an intervention to make the market work much better. Thank you, Olo. Jimmy?
Good morning, everyone. Jimmy Mbogo from KTN. Now, I have two questions. The first one is with regard to your loan distribution. We've seen that your loan book has grown by about 20%. So could you help us understand how these loans have been distributed in terms of sectors? And also, loan provision has also increased, has also grown by. So in terms of areas, are there specific areas that you're concerned about? And back to the issue of the FX market, we want to understand, has there been artificial shortage, and going forward, what needs to happen to make sure that this does not happen again?
Very good. Alex, you can put slide 28, and I'll ask Mary maybe to talk to it.
Thank you, James. And if you look at the full investor briefing, you'll get all the information you need on slide 43. So there's a full sector distribution in terms of our loan book. The largest comprises of trade at 23%, personal household, which is the consumer loans, at 22%, and then real estate, which we've been focusing on bringing down, is now at 14%, and the rest is distributed among the rest. And if you look at as well distribution among the countries, you'll find 62% sits in Kenya, 23% sits in Equity BCDC, and the rest is distributed. So we have a very well distributed loan book in terms of risk. Is there any specific sector we are worried about? My answer would be no, no specific sector. Nothing has changed because in terms of real estate, that has been struggling for quite some time, so nothing has changed there. What we would say is the environment that we're operating in is very difficult. With the rise in inflation, disposable income is reducing. And with that, there's bound to be pressure on our customers in terms of their incomes, on consumers in terms of how much they can spend, how much they can borrow, on the companies in terms of how much they're getting in income. And because of that, we do see a difficult period coming up, at least for the next 1 to 2 years. And because of that is why we've seen that pickup in provisions. It's not that we are concerned about any specific sector or any specific customer, but we do see an increased pressure in terms of the operating environment, and we may see some pressure coming for our customers. And because of that, we chose to be conservative, we chose to be prudent, especially with our general provisioning. We did pick up on our what we call forward-looking information in terms of the macroeconomic factor that we use. We did pick that up about 50% in December of 2022, but this is just in line with the macroeconomic environment and no specific sector worries. Yeah.
Daniel Gashau, you have just walked in. I was struggling with a question here, so you can go to the mic as I replay, and I hope your meeting in Central Bank went well. And the question is that Kenyans are expectant that the Forex interbank trading will now function properly. The question was, why was it not functioning before well? And two, I had said we have seen early signs of the marketing starting to function. What gives us confidence it to function properly, and what is the driver of that certainty?
Thank you, Group MD. I will say that to answer the question about why we had a problem earlier, there was a dislocation between the supply side and the demand side. And this is a function of part of the global crisis that we had. We had supply disruptions, we had demand pressures that actually exacerbated well into 2021, 2022, post-COVID. The Russia crisis did inflate commodity prices, and what that did, it put a lot of pressure on especially our import bill as a market. Now, the dislocation happened because customers started, especially export-oriented clients who actually are the ones who earn Forex income, they held on to their flows. And when they hold on to their flows and the demand pressure goes up, then we had this dislocation between where we have the official prices and where the client transactions are going through. So that dislocation translated to then a break between what we were seeing, between our official rates, what we call our interbank rates. With liquidity drying up within the interbank market, that also did put a lot of pressure in terms of the dislocation between the exchange rates. This took place over almost about 18 months or thereabouts. And what I can say is that what we've seen, particularly over the last 2 weeks, is a lot of goodwill. We've had a lot of engagements, particularly with regards to the central bank, the financial markets team. We've had a lot of engagements with the treasurers in the market. There has been a lot of emphasis in terms of bringing back our market to order, because that dislocation definitely was not positive for this economy. And we have started to seeing positive signs. I think as at yesterday, we had already seen the spread between the markets has actually come down from levels of about 12 to 13 shillings to just about 5 or 6 shillings. There's a lot more flow coming into the interbank. We are now getting, especially the exporters are now supplying liquidity back to the interbank. So this is part of the steps that, in conjunction with the market, in conjunction with the regulator, we are now confident that we are getting our interbank market back. And with that, then stability in the shilling comes in. I think for our audience who probably purchase dollars from us, you'll be able to at least speak the fact that there has been sufficient gains. We are now we are lower than where we were about 2 weeks ago by almost 10 shillings. And these are some of the gains that are coming in from the conversations, and they're coming together between both the regulator as well as the market participants. And we expect, with some of the measures that are currently in place, one of the major points is that with the G2G, the government-to-government oil importation program, we expect that demand pressure for foreign currency will come off by almost $450 million on a monthly basis starting from next month. And what this means is that then we'll have a lot more liquidity available to the rest of our customers. So from our import bill of about $1.2 billion on a monthly basis, we expect that depressed demand pressure will provide more stability to our FX, will provide more liquidity to our customers, and this is the expectation from a market's perspective. I hope I've done justice to the query. If I missed anything, happy to give more context.
Thank you very much, Daniel. Beyond James Mwangi. You know, I'm the face of the bank, but you can see the technical capabilities and the skills in this bank. That is why I was yearning for him to come, because that's a technical area. And I thought I had not done justice. And truly, he has confirmed I hadn't done justice to the question, David. Thank you very much, Daniel. Chami, you can now go with the last question. The mic is next to you. There is one more question behind you then.
Let him finish.
Okay.
Thank you. Morning, my name is Otiato Guguyu from Maudhui House. We have seen from the forward-looking provisioning that you're really on provisioning, and even from the projections in your NPL. Do you sort of see growth in the Kenyan market softening this year? And tied to that is the way you are bullish about the region, sort of trying to leverage your regional presence to mitigate that softening in the Kenyan market? Thank you.
As I said, there are two ways of looking at it. Accepting fate, what you have called market, and doing something about it. We as Equity have decided to induce growth by launching the African Recovery and Resilience Plan, what people are calling the Marshall Plan for Africa. We have drawn partners. We have gone to road shows. Like tonight we are hosting dinner for Americans who are in town to impress on them so we are trying like the way the Treasury has solved the Forex problem, to solve the problem of a possible softening in Kenya by inducing growth, by underwriting the debt risk and leaving investors to only underwrite the capital risk. Looking for markets, that's why we have invited the Commonwealth Enterprise and Business Council, become the chairman so that we can really open those markets, working with the governments to have the ambassadors in those markets to be the ones opening the markets for us. We have, for instance, the director of East African Community Trade. Where is she? We have brought her in now in the bank to ensure smooth trading within the East African community, opening the partnership we have signed. We are the operationalizing partner of East African Community, of COMESA, of SADC, and African Continental. So we have decided to deliberately create the demand side for our products, and in the hope that we'll transform. So we are not seeing softening, but also it's important to say, and we have been very impressed, that although we started as a greenfield in Rwanda and never acquired anybody, by last year but one, we had become the second largest bank in Rwanda. This year, we have been declared a systemic bank in Uganda because we have become the third largest bank in Uganda, and we have become the largest bank in DRC. So essentially, and some markets like DRC, I see we are 30% of the entire market. So these are markets that as they grow, it is imperative to say, if one country softens, we are a regional systemic bank, and we are lucky that the Eastern Central Africa is the fastest growing regional block on earth. So it's like when you have boats in the water and the water level of the sea rise, or the boats rise. So we believe that we'll be carried by the fast growth, averaged maybe anticipated to be between 6 and 7. And given that you are a market leader, you disproportionately get a bigger share. Because you have joined partners like to promote trade, then you become disproportionate beneficiary of trade. If you look at our fastest growing line of business is trade finance, which I talked about Kennedy. And Kennedy confirmed, even this year you are growing by what percentage? 45%. So you can see how it will lift the bank. So essentially, it is deliberate, it's intentional growth. It's not we are growing because the market is growing. We are growing because the executive, the management have differentiated themselves by making strategic decisions and executing the decision. We have realigned the bank. Sitting next to me is our Group Chief Operating Officer. He's the one who opened South Sudan, opened Rwanda, and turned loud Uganda. And he has now been told, leave James to strategize, execute. So he has been given a direct mandate by the board to lead operationalize strategy. Now you can imagine that tension. Initially I was responsible for strategy and execution. Now mine is just dream. Can you imagine how much dreaming I would do? And then this man has been told, make sure the dreams are executed. And the bulk, 90% of the bank is now reporting to him because 90% of the people are executing. Just dreamers. I think I have a team of maybe we are 7 in my office. We are 7. The executive director, chief strategist, chief reporting officer, chief economist, communication, and now we have been given a chief legal officer. So can that team in my office start? Yeah, that is the only people in my office just to think, dream, and strategize, and then
we create tension, report to the board what we are seeing execution team do. So maybe, thank you. The execution team, you can start. Execution team. Ajara, you are in execution team. Now you can see how many times they are, the multiple. So you can imagine this bank has always been very strong in execution. Now you can imagine what it will be when now that creative tension is created between separation of dreamers and executioners of dreamers, and a good tension of blaming each other. We really look at your side. This is not a game of numbers. We wish you well. Thank you. Chami.
My friends, analysts have finished, eh? And the press. Group, professor, non-executive chairman, group CEO, group madam chief executive, and all the other protocol observed. Now, group chairman, let me address, because I have to address you. I know the protocol. We are very impressed as direct and indirect shareholders for the transformation and improvement you are doing to the bank and to the group. Because I have attended so many investor briefings this time, the ones who have been there before. But nobody has never talked like you are talking. In fact, we could need to listen to you up to 6 o'clock. You don't have a license here to stop the meeting, because this is your room. You have the license inside here. There's no police control and everything. Because your speeches are encouraging to all the people who are here, especially the shareholders. I'll introduce them, some who I have come with, I'll introduce later. Now, Group Executive Officer, you are focused. If you have gone to this year, and this year has got war on minerals, I don't know how you are going to get your factories working in this year, and they are in the forest. Some are from Rwanda, some are from where? Some are from Kenya for peacekeeping. They are all after the minerals in this year, the DRC. But you have done a very good focus that you want to get factories to do the minerals, and we get wealth. And that is very important. Now you have improved Rwanda. Already you are improving Uganda, Tanzania. I see you have got an office in Ethiopia. You did not comment on that, but anyway, I think it's still an representative office. I see there's Equator. Equator, I think you can compare with Safaricom. You have not said about your position in Equator, but you'll tell us. I know you are very frank and you are capable and you are doing well. I did not make a mistake when you came to stock exchange to say Mwangi tosha. I did not make that mistake. Na umetosha mpaka today and you are still unatosha mpaka unaendelea. Na mulikuwa na Madam Mary, who is now chief executive on the board and on the management. She used to be our legal. I think nafikiri aliandika sana my questions and answers which I was asking in those meetings by then. I met Alex Muhia. Alex Muhia was always my friend during the AGMs. Said, Chami, let us work together. And he also said, let us work together. And Mary was busy writing about our questions and answers. So that means we started well. We are going on well. From here, we are going ahead. And you have done very well to promote the people you are with. You have already promoted Madam, the only lady I think there are two now, but Madam, you know, is executive. You have promoted the Mwamba. Mwamba, what is the Mwamba? Chief Audit. You don't need now auditors from H&R or the other ones, the external. You rely on now on the accounts. Once he improves, he approves, then we can rely on that. We don't have to ask more questions about that. So, since I have known the story of equity, I'm with you. I always be with me, and let us go together because me alone cannot do anything. You alone cannot do anything because you have brought all the all the people to support you. And you have already made them stand up. We have seen them. And in fact, we are very, very happy that you go on like that and wish you well. One day, don't be ill that you leave the bank and for 1 week, unless Mary takes over, and she also waits for that until you come back. So that's why we are wishing you well all the time. Be in the bank in the morning, as you have said. So I think let us just wish you well properly, because God will always help us if we are doing well. So in agriculture, if you are doing well, I think you'll have now to start importing fertilizer, seeds, because many people have failed in that period. In health, I don't know that there's HRF, inaitwa nini, ile insurance. I don't know which insurance you need in Equity Afya, because I have not attended that Equity Afya. I see it. I just passed Equity Afya, but I see it is from Equity Bank, but I've never attended when I'm sick. So I don't know what benefit you have given to the poor and to the rich about Equity Afya. I know you have given so many incentives. You have brought us so many things that improve the lives of, touch the lives of the Kenyans and other people. All the East Africa and Africa, as you have said. When you attended in Arusha, that summit, I heard you talking very well. So I thought you are a president there in that meeting. So I was very impressed when I was on the TV. So I think I wish you well. Continue encouraging, continue training. I don't know how you train people to go and become good doctors in other countries, like in America and where. I don't know where you get this. That siku ingine niambie, kwa sababu tutakutana wawili, niambie you are getting miracles from somewhere, either from God or where. So I think that's why when you have a meeting, I must come and attend. But I have also to call others that let us go and attend our group CEOs meeting, because you are always encouraging, and that your encouragement, we are also learning something. We have learned a lot today. We have learned a lot today from you. The improvement of dividend, that one I know will continue as long as you are on that chair. That chair is only one, and it's for you. So that's why we are saying continue, wish you well, you are capable, and continue with all the whole of your team. And as you say, they are your comrades. That's very encouraging. So it is good that you are doing that. And we started with you. That's why I'm saying, when we started, I didn't know that we shall improve Equity Bank, kushinda hii bank yote ya Kenya. If KCB was there. Yeah, KCB was there, and it was also both government and both bank. But yours is capable, and you have not changed any board members and whatever. KCB is now changing board members every time, and that. Even those who have been in the government as coming in as experts. So I think, let me just wish you, because I don't have any question at the moment. Mine is a comment, good comment, to comment on you, to comment on your management, to comment on your staff. Whenever I call your staff, they are always answering. I don't know how you are trained your staff to reach other people, even the branches. The branches, there are 2 branches I stay with together. When you reach them, even the manager greets you on the door. And when people see that, when the staff see that, they become very disciplined. So, tuendelee hivyo, as Equity, I think we shall reach somewhere, we shall be number 1, and we shall not be number 1, we shall be 0 on top. When we are 0 on top, we shall be praying to God that now, Mungu atusaidie tuishi tuone banki ikiendelea. Thank you very much, ladies and gentlemen. Asante sana.
Thank you, Chami. We want to thank all of you for coming and for attending the Equity Group Holdings 2022 full year results investor briefing. The investor briefing, together with financial statements, the press release, is available online, and as you leave, you're also going to get a copy. Thank you for coming. We look forward to engaging with you. For those who have questions, please engage us online. Our investor relations teams will get in touch with you. Allow me now to invite Bishop to close for us with a word of prayer. And remember, there is still some breakfast as you leave. Thank you once again, and God bless you. Bishop.
Thank you, Alex. Shall we pray? Father, we thank you once again for that wonderful meeting that we have had. We want to thank you and bless your name for what you enabled us to do in the year 2022. We know that, Lord, it is by your presence, your favor, and your unfailing support that we are able to do beyond our expectations. Today, we are grateful for allowing us to record those results. We bless you and we thank you. We also want to thank you for all our customers who walked with us. We thank you for the investors. We thank you for all who are involved. As we move forward, we also want to pray that you extend your hand upon us this year, 2023, and give us results that are even beyond our expectations. We bless you. We thank you for all those who have attended physically and those who are following us online. We pray that you bless them. As we leave, we pray for your grace. For this we pray in your holy and precious name. Amen. Thank you.
Inuka na Equity.
My name is Munir Thabit Suleiman, the CEO for Grain Industries Limited. We are manufacturers of flour, both maize and wheat. We are the biggest wheat miller in the country by capacity and market share, producing 2,250 tons a day of wheat and 400 metric tons a day of maize. The only mill in the country that is ISO 22,000 food safety certification, together with ISO 45001 occupational safety certification, together with ISO 14001 environmental certification, and the only mill in Eastern Central Africa that has a fully fledged microbiological lab that is able to detect the various toxins, aflatoxins. The ISO FSC 22,000 food certification is actually you have got to go through a very grueling experience whereby everything is documented and everything is monitored. And that level is easier as a result of our investing in automation. You see, the lesser number of people you have, the lesser the contamination and the lesser the mistakes. The grain is not touched from intake up to when it is in the packets. We actually are the only millers in this country who are now supplying to KFC Kenya, KFC Uganda, KFC Rwanda. This is Kentucky Fried Chicken, because they were happy with our standards. They actually used to import the flour from elsewhere. I'm also the board secretary of the Cereal Millers Association. All millers in this country have an association, and the association is the Cereal Millers Association, where we look and lobby for issues pertaining to the milling industry. Ajab is the product that actually is a household name in this country. And it was done after a survey where we realized that being sub-Saharan Africa, it's not every household that has a mixer. And so kneading the dough is done manually. And so it was good to have a blend of a product that actually helps the mama. Multi-purpose products that would fit in from chapatis to samosas to what have you. We work with various distributors, wholesalers, sub-wholesalers, Horeca, that is hotel, restaurants and cafes and eateries. We also deal with bakeries, so we do also supply to institutions directly. Our journey with equity started from inception because we knew that to have a very good product, you actually needed to partner with somebody who understands your business, with somebody, a stakeholder who will walk the baby steps with you from inception, and a stakeholder who will grow with you. And we found those qualities with equity. And so Ajab and equity started the baby steps, where when we started, we were just doing 750 tons. We were not the biggest wheat manufacturer. But within 48 months, that partnership has turned into fruition of being the biggest wheat miller in the country. And we are glad that we chose a good partner who will grow with us, and we continue to grow. Like bill stabilization. Bill stabilization has a very big advantages in that it cuts your costs insofar as letters of credit is concerned. And you move much faster with speed, and it's a trade finance instrument that actually facilitates international trade. And so by having a bank that has international correspondence and is able to actually access the dollars and facilitate your trade, allows you to be an international player. There's also retail financing, and this is being rolled over countrywide, where they don't have to struggle to stock their shops, resting assured that equity pays us immediately and then the customers pay equity later on.
Initially, they started at a capacity of 750 metric tons per day, and within 2 years, they had increased that capacity to 2,250 for wheat and another 400 for maize. We also have pay with equity with their retailers and their distributors. So we can say that they consume almost all our products, and their top management also bank with us. Credit cards, the company credit cards, they're operating throughout the country. They're not just in Mombasa, and they're big in terms of their muscle, even their capacity.
There was also asset financing, which is also a critical part. Mind you, to do a distribution, you need the products and the means to deliver that. And so you need a massive fleet, and you want a stakeholder where you're able to move with speed to the last mile. And Ajab found equity to be that partner that can actually deliver that. We do source our wheat from international market, of course, plus locally when they're harvesting in the Narok and Eldoret areas. For the maize, Kenya is a maize deficit country, and we actually now are sourcing it from both Tanzania and Zambia. To the mamas, aflatoxin is a carcinogen, and Ajab is the only brand that actually has a toxin-safe thumbs up sign. As you think of your children, as you think of your family, think Ajab, because it's the brand that is easy to knead, gives you more, and at the same time is safe.
My name is Lorraine Aquino Pondo. I am a nurse by profession and I work here at St. Monica's Hospital as the HIV service lead and the deputy administrator. So this is a level 4 hospital, a mission facility supported by the Catholic Archdiocese of Kisumu, and we have both inpatient and outpatient services. We also have a nursing school, that is St. Catherine's Nursing School, where we do diploma, that is KRCHN, according to the government guideline, and they are licensed by the Nursing Council of Kenya. We've worked with the Equity Bank for quite some time as a facility and even as a diocese. During COVID-19, the pandemic, we were hard hit in terms of commodities and the personal protective equipment at the hospital. So we reached out to the Equity Bank through their program that was taking care of the pandemic, and they came in to support us. The group MD and the CEO of the bank was here on one of the occasions. They donated and put us in the portal for support for PPEs during COVID-19. So I think that really strengthened our relationship, and while the team was here, they also did a tour of the hospital and they noticed that by then we were still using charcoal at our kitchen. So a team was sent from Equity Bank that is dealing with green zone energy. They visited our facility, assessed our facility, we interacted, and they gave us advices on green energy, and we took it up because we felt it was something worth noting and worth taking care. One of the team members that came from Equity Bank, she asked me a very simple but challenging question, that you can imagine if the kitchen looks like this with this suit. This staff who has been working here for years, how is the lungs? What do you think goes on in their body? And that was a bit disturbing for me. When we did the cost analysis of using the LPG versus using the charcoal, we realized we would save a lot of money on that instead of buying the charcoal. The cost of charcoal has really gone up. It is not available in the market. And with also the government regulations, even getting charcoal and the logs for burning the charcoal is becoming tricky. That already tells you that in the near future, charcoal will not be available readily for most of us. Our kitchen was covered a larger percentage with soot. And our staff would also complain of chest complications a number of times. So when we transitioned, it's usually very nice to go to the kitchen and you get the staff, they're like, no, they're more efficient because they can cook faster. And again, they can prepare meals on intervals. Like when a patient walks in, when they're done cooking, they can do that. And they save energy in that when they are done, they switch it off. Unlike charcoal where you'd leave it the whole day running. If we have to take care of Mother Nature, we have to make certain decisions for our children tomorrow to have a better environment. One of them is transitioning. For us, it has been cost effective. For us, it has been motivating factor for the staff that are working in that department. And for us, it has been more efficient. Even if a patient walks in at this time when they have just given lunch, we are able to make that food very fast for that patient, and it is still cost effective. Shout outs to my family, Piri, Emma, and my sisters who are also in other institutions, my brothers. We can have a discussion so that you consider the green energy. It's the best, it's the way to go.